Hi everybody. In this series of Chapter 18 study guide videos, we'll explore the accounting for preferred stock. We'll talk about cumulative versus non-cumulative preferred stock. We'll calculate the dividends on cumulative and non-cumulative preferred stock, and we'll see how those dividends are shared between the preferred and the common shareholders. And we'll talk about treasury stock. Please do two things before watching these videos. First, thoroughly read Chapter 18 in your textbook and work the exercises provided in the chapter. You will need a thorough understanding of the chapter, as these videos will only present some of the chapter highlights. Second, download the Excel files embedded on the Chapter 4 study guide page, so you can complete the exercises as you watch the videos. In this video, we'll discuss preferred stock. As always, you will get the most value from these study guide exercises if you will take the time to pause the video and prepare your calculations and journal entries. Then start the video again to check your work. If you got it right, you'll feel great. If you didn't get it right, that's okay. Now is the time to understand why you made mistakes so you don't make the same mistakes on the upcoming exam. There will be a detailed analysis of the correct answer that should give you an opportunity to understand and fix your errors. Preferred stock receives dividends before common stockholders receive any dividends. Preferred stock also has a preference for the distribution of assets if the corporation is liquidated, and preferred stock usually does not carry voting rights. Let's look at an example. Johnson Boating issues 750 shares of $100 par value 6% preferred stock for $100,000 cash. Write the journal entry to record this issuance of preferred stock. $750 shares of $100 par value preferred stock were issued. 750 times $100 each equals a $75,000 increase to the preferred stock account. So debit cash for the $100,000 of cash we received, credit preferred stock for $75,000, and credit paid in capital in excess of par, preferred stock, for the $25,000 difference. Now let's talk about the dividend preference on preferred stock. Preferred stockholders have a right to receive their dividends before any dividends are paid to common shareholders. However, there is no requirement whatsoever for a company to pay dividends. So the preferred stock, and for that matter the common stock, is not guaranteed a dividend. However, if a dividend is declared, the preferred stockholders have a right to receive their dividends before any dividend is paid to common shareholders. Dividends allocable to preferred shareholders are usually expressed in a dollar amount or expressed as a percent applied to the par value. Let's look at another example. Johnson Boating has 750 shares of $100 par value 6% preferred stock issued and outstanding. Calculate the amount of dividends the preferred stockholders would be entitled to receive if the company declares and pays a dividend. $100 par value preferred stock, 6%. So $100 par value times the 6% equals a $6 dividend per share times the 750 shares issued and outstanding equals $4,500. If a company declares and pays a dividend, the preferred shareholders in this case are entitled to receive the first $4,500 of the dividend declared and paid. Now let's discuss cumulative versus non-cumulative preferred stock. Non-cumulative preferred stock is not entitled to receive any dividends or shortage of dividends for any year in which dividends were not paid or an amount was not sufficient to satisfy the commitment to the preferred shareholders. In other words, if they didn't get the dividend, they lose the dividend in any year. Cumulative preferred stock, however, is entitled to receive dividends for years in which dividends were not paid or an amount was not sufficient to cover the commitment to the shareholders, preferred shareholders. The unpaid dividends accumulate, and it's referred to as dividends in arrears. The unpaid dividends accumulate, and if a dividend is paid, all dividends in arrears must first be paid to preferred stockholders. Then the current year committed dividend must be paid to the preferred stockholders, and then and only then will the common stockholders be paid any remaining dividend. Well, that's all for this video. In the next video, we'll talk about an example where we will calculate the amount of dividend to be paid to the preferred shareholders, and then we'll calculate how a dividend is shared between the preferred shareholders and the common shareholders in an example when the preferred shareholders have cumulative preferred stock, and in an example where the shareholders have non-cumulative preferred stock. See you next time.